Business Week. My name is Tilewa Adebajo. My guest this afternoon, a distinguished researcher, Managing Director, CEO of ProShare. I have with me Mr. Femi Awoyemi. We're going to talk about the performance of the equity markets in Nigeria year to date. Femi, you're welcome to the program.
Thank you very much.
Now, Femi, where do we start? Looking at the numbers in front of us here for the markets, they don't look good. I've looked at every single sector, and I think that maybe only two sectors have showed any significance, and overall, the market is down.
Yeah.
Have we seen the bottom of the market, or are we going down further?
Unfortunately, from our own standpoint, if you take it back from 2008, there are about 5 stages we anticipated up to today. First, we thought that the crash would occur, which happened in 2008. Then there will be denial all throughout 2009, where you found out that nobody was really taking any action. And in 2010, we expected the recovery would begin. The figures suggest us that it is actually that, because we had a decline we had about 33.58 increase in the index. But in 2010, which was meant to be the adjustment and rebuilding year, we seem to be stuttering. We believe that we should find a bit of correction somewhere down the line. The only problem, however, Tilewa, is that you just can't point to a discernible pattern or to what you expect. The volatility in 2010, if we discount for election year, if you discount for the issues within the banking, there just seems not to be that stock that just pops out for you.
Well, I mean, so obviously, I think without doubt, I think the sector, we will go back to the sectoral analysis, but I think the sector that has actually performed quite, I think Nestle, stands out, I think clearly.
Correct.
But unfortunately, looking at these numbers, we see that out of all the sectors in the market in terms of performance to date, airline services, breweries, real estate, conglomerates, healthcare, those 4 sectors were the only one that has a positive year-to-date gain.
I mean,
all other sectors have returned negative.
It goes without saying that you get the financial services market that the industry, the government policy fosters upon you. The market is basically reflecting the conditions in the economy. And basically that's what you see. The Nigerian equities market, as I see it personally right now, is, for lack of a better word, we just seem not to be there. You see performances increasing. There seems to be a disconnect between the fundamentals and the market realities. Performances are increasing, people are declaring significantly good returns that should naturally affect the market. But it goes back to the simple question that without liquidity in your market, without floats in your market, there really is no market. It's just like we're cycling the same thing. And if you look at those sectors you talked about, ironically, those are the sectors where there are no significant FDIs. Our manufacturing sector has the lowest FDI in place, but yet it's the one that gives you the most, which tells you something. That these companies, because of their relationship with the market, with the people, they consistently will perform. And one thing that should strike you out is that you don't see any consistent pattern between 2008 to 2010 in any particular stocks, for example. Certain sectors are just blighted out. But like you said, my thinking is that what you see in your financial market outcomes are a function of your government policies and your economy.
Well, let's take a look at those disconnects that we've talked about. You talk about the economy, and economy is growing at 8-9% per annum. I think that's clear. But it's, as you've also said, manufacturing contributes about 4% to the GDP. And we now have this clear disconnect in terms of the markets. Most of the companies are coming up with good results. But the investor confidence, most of this is not being reflected in the pricing. So are we saying that this whole issue of the correction and the whole essence of the way the markets were inflated, has this correction ended, or is the market bottom? I mean, it seems to me that we're not there yet. The correction is not over. The market is still correcting. And of course, we haven't seen the bottom of this market yet.
When you talk about correction, what you correct basically is not just pricing. You correct the fundamentals of the market.
Exactly.
What you've seen is a correction in terms of pricing, which means that because you just find you prick a balloon and it just goes flat. You haven't sorted the problem out. What you will find really, which is my concern, is that you find that the Nigerian financial system could not sort out itself until the CBN governor came in. Which shows you that the way the Nigerian financial system is so interlocked is that it is driven by only one singular sector, banking. Be it in terms of market cap, which is not really a good barometer, but in terms of the flow of money. Now, if we talk about liquidity, it goes back to banking. If we talk about what led to the growth, it goes back to banking. In the first place, you go back to these sectors that are now performing in 2011. They were not those sectors that were just the prime movers of the growth then. So they haven't been totally affected by the bubble, as it were.
Yeah, so it seems to me that the one particular sector, which has been the banking sector, is what has been responsible for dragging the market down. Because if you isolate
it was the one that brought it up in the first place.
Brought it up and then also taken it down.
Exactly.
So basically, if you stuck with your bread and butter, FCMG, regular, real sector type stocks,
exactly,
over the long term, you'd have been better off.
You would have been better off.
Okay. Now, let's take a short break and then we'll come back and talk about the market capitalizations and we'll talk about sort of trading volumes before we begin to take a look at the sectoral analysis. I'd like you to introduce your first song.
Human Nature by Michael Jackson.